Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday, the 4th of April, 2020, and we're publishing our gold and silver weekly update for the week ending the 3rd of April. Gold fell $14 last week from $1,632 to $1,618, having hit a high of $1,635 and a low of $1,572. A fall of just under 1%, but this does follow a $134 rise the week before. In sterling terms, gold finished the week at £1,318. That's up £9. And in euros it closed at €1,497. That's up €33. You can see a slight disparity between the change in price between these three currencies, but in a nutshell, the bottom line is that the dollar has strengthened against sterling and the euro, but especially against the euro last week. Silver fell 21 cents, from $14.62 to $14.41, having hit a high of $14.62 and a low of $13.84, but again, this follows a previous week's rise of $2.03. In sterling terms, it closed at £11.74. That's up 6 pence. And in euros, it closed at 13.34 euros. That's up 0.26 euros. The gold to silver ratio rose slightly from 111 to 1 to 112 to 1. The Dow Jones closed on Friday at 21,052. Above that psychologically important 21,000 level, but was down to 360 points on the day and down 584 points on the week. The S&P 500 closed at 2,488, down 38 points on the day and down 53 points on the week. And the Nasdaq closed at 7,373, down 114 points on the day and down 129 points on the week. So this generally represents monthly falls ranging between 14% for the Nasdaq, 16% for the S&P 500, and 18.6% for the Dow Jones Industrial Average. Brent crude closed at $34.11, up a considerable $9.18 on the week. And WTI crude closed at $28.34. That's up $6.83 on the week. Last week, oil prices were falling through the floor until President Trump tweeted at the end of the week that he expected producers to cut production by at least 10 million barrels and potentially threatening tariffs on oil imports. This caused prices to rise in anticipation of such a move, and we reported on this during last week, but particularly in yesterday's video entitled Europe's Parlous Economic Position, plus oil, plus gold, plus silver. And we've placed a link to this video, if you haven't already listened to it, in the description box below. Now the dollar index stands at 100.57. That's up 2.21 points on the week, and has now broken again that not only psychologically important, but economically important level of 100. Now each day last week we produced a daily update, as there was a considerable amount of data being published, and we knew there was the potential for quite aggressive price oscillations for gold and silver. It's ironic in a way that despite pretty negative data, net prices were overall little changed. Part of the reason for this was the considerable rise in gold and silver prices the week before, then a considerable fall in both of these early in the week, resulting in lows on Tuesday in the case of gold and Wednesday in the case of silver. But despite this, they both then staged a moderate recovery or modest recovery thereafter. Now, we did mention in last week's update to expect a degree of consolidation overall, even though we were anticipating oscillations. And the net result really has delivered just that. In fact, We ended the update with the following conclusion, quote, "There will be pressure on the precious metals next week, though once again we still favour gold over the short term. We suspect silver may struggle, but if gold continues to rise, then silver will be dragged up with it." We also pointed out that the big day today was going to be Friday, particularly with the non-farm payroll report, but to watch out for the other payroll or employment figures. So on Wednesday, we had the ADP employment report, which showed a minus 27,000 figure compared with a plus 179,000 the week before. Then on Thursday, we had an appalling weekly jobless claims report of 6.6 million, compared with 3.3 million the week before. In other words, twice as many people claimed unemployment in a week. On Friday, the non-farm payroll report showed a net loss of 701,000 jobs, compared with a positive 214,000 in February. This is the largest monthly decline since March 2009, an important year one may remember. The unemployment rate rose from 3.5% to 4.4%, which incidentally is the largest one-month increase in unemployment since January 1975, over 35 years ago. Though average hourly earnings rose from 0.3% to 0.4%. So at least those in work had on average slightly higher pay, allegedly. In addition, on Friday, the Market Services PMI for March was published, which gave a reading of 39.8 against February's 49.4. And the ISM Non-Manufacturing Index for March gave a reading of 52.5% against February's 57.3%, but was higher than expectations of 43%. Now, we did mention earlier in the week that the non-farm payroll report, based upon when the data is collected and collated, did miss out on the week of the largest falls, and therefore we would not be surprised to see an even worsening figure next month. In fact, it's almost guaranteed. To some extent, the market did expect these figures, especially when watching gold as a barometer, to see its price rise on Thursday and then being more or less sustained on Friday. And this in spite of a strengthening US dollar, which usually acts as a headwind on gold and silver prices. From a technical analysis point of view, we are in interesting territory. To quote verbatim analyst David Becker, whom this week has given, in our view, a really good analysis, and therefore there is no point us trying to compete with it, as it does reflect our view too. Quote, "Gold prices edging through resistance near a downward sloping trend line, which might be considered a breakout. Support, which was former resistance near the 50-day moving average at 1,593. Target resistance on the yellow metal is seen near the March highs at $1,700. A short-term trend is now positive. The 10-day moving average has crossed above the 50-day moving average, which means that a short-term trend is now in place. Short-term momentum has turned positive after just turning negative. Fast stochastic generated a crossover buy signal. Medium-term momentum has also turned positive, as the MACD, the Moving Average Convergence Divergence Index, generated a crossover buy signal. The MACD histogram also generated a crossover buy signal, but the trajectory is now flattening, which reflects consolidation, unquote. Now, listeners to our channel know that in the case of recession, we prefer gold over silver because, of course, with silver, you have the industrial demand component, which historically ranges from 55 or closer really to 60% of demand generally, this being decimated during recessionary times. It's only when gold prices really take off, because of monetary demand and currency protection purposes, does it then drag silver prices up with it. And then one hears the pumpers often call for a blow-off top, which is then when silver surpasses gold, when gold is at its peak, which then makes the whole concept of silver investment worthwhile. But because we're not anywhere near that position as yet, and because the industrial demand is clearly reducing or envisaged to be reduced to such an extreme level, this is why we see such a large gold to silver ratio. And why, quite frankly, we have, particularly over the last 12 months, called out those pumpers who kept telling us to expect the gold to silver ratio to fall back to 80 to 1, then 60 to 1, and all the way down to 15 to 1. This will almost never happen in a recession, save when gold prices rise so much that silver is the only other affordable option for private investors. And as we can all see, we are nowhere near that position as yet. We also wish to remind investors there is no shortage of gold and silver currently above ground. It's just not in the locations which are accessible for those who are currently demanding it. And those who have it are, understandably in some cases, perhaps the majority of cases, but we have to wait and see, they are reluctant to give it up. Though Russia has, surreptitiously perhaps, let it be known that they may consider selling some of their gold holdings, but they are certainly not currently buying any more. Now, in addition, one only has to look at either zero or negative premiums in China on gold to understand that it's not necessarily a situation of a lack of availability, but simply logistics, which is why we have stated time and time again, be careful with your buying and try not to pay too high a premium if you can. There will be gold, and we believe enough gold available in a few months' time for everyone who needs it to acquire it. Now, that said, we are positive gold, certainly short term, and certainly more so than silver, and can indeed see the consolidation tempering more to the upside than the downside at present. Now, silver last week had a considerable initial decline too early in the week, and then began staging its recovery really on Thursday. There is general consensus that $14 offers considerable support and $15 resistance, but is where silver is desperately attempting to reach. Now, technically speaking, a small bullish flag is developing, and only when silver rests above the $15 level can we regard it as a sustainable rise, which could then move quickly towards $16. But even if that happens, we really find it difficult to foresee silver going beyond $17 in the current economic climate. So where the dollar remains strong and global growth weak, silver frankly is somewhat tempered, and only if there is a significant breakout to the upside with gold can we see silver forming anything like a bullish recovery, certainly within the next couple of months. The key relationship, though, in our view to watch out for is again the United States dollar, and we shall come back to this in a moment. But first, let's take a look at this week's US economic news scheduled to be announced. On Monday, well, there is nothing planned really. Tuesday, consumer credit for February. Wednesday, the FOMC minutes should make interesting reading if they are actually published. Thursday, weekly jobless claims. How much more than 6.6 million will they rise to? Also, producer price index for March, consumer sentiment index for April, and the wholesale inventories for February. And then on Friday, the consumer price index for March and core CPI for March expected at 0.2% or maybe even just below. So apart from anything that can be gleaned from the FOMC minutes, Thursday is the largest and most important data day, and Friday perhaps supporting what we learn on Thursday. Again though, the weekly jobless figures will have the most attention and possibly reaction. Now let's get back to the dollar. Now this could form a video all on its own, and perhaps we might produce one, but our view is that a dollar index above 100 is generally not particularly that great for the US economy. However, with transport being generally restricted, its effect will be less severe than normal because exports will not be as greatly affected by this particular criteria. Now that said, it is potentially too easy to write off the dollar, and this is something that some other channels are still doing, despite financial evidence to the contrary. Now, whilst we would not like to see this, there is considerable potential for the US dollar index to reach and surpass its 2020 highs. We mentioned a while ago that when the index was around 95, 96, we stated to expect a rise to above 100 and potentially reaching 105 in the coming weeks and months, and eventually 110 being a not impossible outlier, though we were more comfortable, obviously, with 105. Now, we're still of this opinion, and this is despite the Fed having lowered rates twice last month. Now, if we're right, and this does happen in the coming weeks, this will put considerable pressure on gold, and by nature silver too. It's our assessment that gold will rise a little further before this happens, and could even rise a little while the dollar does as well. But if the dollar's upward move is sustained as we suspect it could be, and we estimate that probability factor to be as high as 70%, then gold will top out in US dollar terms and then potentially quite rapidly decline. Now, of course, much also depends on the geopolitical situation and any additional financial stimulus injected into the economy, but we must warn that this is an above-average possibility. Another reason we're saying this is that the pumpers have never produced so many videos so frequently as they are at present, advising you to jump in and acquire gold wherever you can, regardless of premiums paid. Now, there is, in our view, a 30% possibility that they are right. But short term, that is, over the next few months, we believe they could be as much as 70% wrong. And we cannot help but fear that they know this dollar rise is coming too. And if gold does fall back because of it, once again all of their predictions will have been seen to have been, let's be polite, a false dawn. If also, as we suspect, in 3 to 6 months' time, precious metal distribution is fully reinstated, and at the same time we've reached peak dollar, then gold prices will have fallen back, and then, in our view, could indeed offer a tremendous buying opportunity, taking a 2 to 3 year view into account. For then countries will have to attempt to deal with the aftermath of paying for their money giveaways and support spending. Now, if we're right, and the dollar does rise to 105, and potentially, as an outlier, to 110, then although the dollar value for gold could go down, the sterling value, the euro value, the Australian dollar value, and the Canadian dollar values could to a large extent be maintained, marginally to the downside, but generally maintained, as the currency correction will mitigate the loss in the dollar value of gold and silver. So please bear this in mind. As we say, and we reiterate again, according to our estimates, a 70% probability factor, and nothing is absolutely certain. It would be interesting to see if we are proven right. And we are going out on a limb, to be fair, at this stage, expecting gold still to rise a little further first, rather than waiting until we were more confident that its value had topped out, at least short term. So we're staging this as a warning, or an opportunity. However, if we didn't do this so early on, then we would not be as controversial or contrarian a channel, as many of you who have followed us for years know that we are, and to be frank, let's be honest, expect us to be. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting that we update our Richard and Greg channel every other day, and so if you haven't already done so, please subscribe to that one too, and another update will be published later today. Finally, we are aware that some of our silver subscribers have started receiving their 1 ounce silver 2020 near proof like Illuminati silver round, and as we mentioned in yesterday's video and Thursday's video, those living in the United Kingdom may have a 10-day or so delay because we've arranged for them to be sent to our offices so that we can send them out internally, thereby you avoiding being charged any VAT or import taxes. We trust and hope that you all have an enjoyable and perhaps more important currently, safe weekend and week ahead. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.